Thank you for tuning in to the Equity Channel, where we provide the highest quality stock market analysis to individual investors. Our goal is to help you improve your returns while keeping you up to date with everything that you need to know. What helps investors beat the market is information and knowledge of how to use it, and we'll provide you with both. Before we get started, be sure that you subscribe and turn on your notifications because every time we drop a new episode, money is made. All right, all right, all right. So today we are operating on Twitch and Twitch alone. One second here. All right. Today we're operating on Twitch and Twitch alone. I hope that this still allows those who want to be a part of these sessions to make it through. All right. So I'm looking forward to seeing who pops in, who does it, man. Drop a little emote in the chat, man. See that little smiley face in your see that little face in the bottom of your chat right there? That's where your emotes are at, man. Drop a little emote or something right now, man. If you you know, drop me an emote if you in the chat, man. Let me see who's here. Let me see who's in the building. Okay, okay, okay. I see you, Lady B. What's up, Cecily? What's up, Aldrin? What's going on, man? What's up, Grizz? Okay. See, Corey always in the building. I try to tell y'all that, man. I try to tell y'all, Corey always in the building. You know? But we ain't trying to say nothing, right, Corey? We ain't trying to say nothing, you know? What's going on, folks? What's going on? What's going on? If you just popping in, drop an emote in the chat. Let me know you here. Drop an emote. I see 9 people there so far. I only see 5 emotes in the chat. Where the rest of y'all at? Oh, you know what? They may be on commercial break right now. I forgot. I forgot. I forgot. I forgot. But you know what? Lady B, she already dropped her emote. You know what I'm saying? Okay, the goat emote. The goat emote. All right. So tonight Tonight, I'm gonna be walking y'all through some. Gonna be walking y'all through some basics, right? I promise that for the newcomers, we talk some basics, right? Promise we talk some basics. So, what's up, Anisha? What's going on? What's going on? I promise we talk some basics, right? And I forgot about step 6. Hold on. You know, verify the margin of safety. All right. See, I already know what step 6 is. We're gonna come back around to that though. All right. Don't. Okay. So I'm gonna walk you through this thing step by step. Okay? I'm gonna walk y'all through this step by step. And you know, we're gonna go from the original from the origin points of the analysis, right? And then we're gonna work our way all the way through to the end, to the point where you would be making an investment. So please pay close attention. All right. Um, how many of my new people in the house, man? Where the new people at, man? Please tell me y'all went and joined that Telegram like we told y'all to. Please tell me y'all went and joined that Telegram like we told y'all to. Let me check Clubhouse again, because we might have to remind these folks again. Or do I got to go back to the days where we do I need to go back to the days where we would only put the Telegram at the top of the room? I might have to do that, huh? Nope, Clubhouse is still not working, y'all. Clubhouse is still not working. So, I'm gonna post this on YouTube so that the newcomers can get it. Post it on YouTube so the newcomers can get it. But all right, let's talk about it. Evaluating a company is it's pretty simple, right? I have 6 steps here for y'all. 6 steps that you need to follow. If you want to analyze a company, find you the good ones, okay? Find you the good ones, all right? And, get to making some quality investments. Are y'all ready to go? Y'all ready to get this done? Let's talk about it. Step one is to screen the market to eliminate weakness. That's the first thing you should do. Y'all hear me? Screen the market to eliminate weakness. Now, I'm not just going to go through these things step 1, step 2, step 3, and boom. I'm going to go step 1, and then I'm going to show you how to do it. We're going to come back. We're going to talk step 2. I'm going to show you how to do that. Okay? So I'm going to walk you through this one thing at a time. You with me? Let's go through this, all right? I'm going to use the FinViz screener today. So we're going to go over the FinViz. That's step number. Let's go to FinViz. We got to screen, right, the market to eliminate weakness. Let me show you what that means. Go to FinViz. All right. Now, here's the reality, right? The reason we need to screen the market to eliminate weakness, here's the reason why we need to do that. We need to do that because when it's all said and done, right? When it's all said and done, there's too many companies for you to go over one at a time. You can't go through these companies one at a time. Okay? We gotta eliminate that thought out of our mind that we're just gonna randomly stumble across the right company on a regular basis. No. What you need to do is you can speak to the market pretty much, right? You can actually speak to the market. Good evening, Alicia. You can actually speak to the market. You can say to the market, hey, can you do me a favor, please, and get rid of these companies here, get rid of those companies there, get rid of these companies here, right? You can do that, believe it or not. All right, and here's how you do that. You go to the screener right here. It says screener right here. Go to the screener. Click on that. Now you can see when we go to the screener, there's 11,115 total tickers here. 11,115 total tickers here. So this is why I said you have to screen away the weakness first. Because if you don't, what's going to end up happening here, right? What's going to end up happening here is that you're going to have too many things in front of you. That increases your odds of picking a bad company. Let me show you what I'm talking about, right? If I was to say stocks only, no shell company, no, let's say just say stocks only, no mutual funds, right? No ETFs. Let's say I said that. You got 5,575 names. Let me show you what your odds are of picking a company that's not even profitable. Now, I'm going to give y'all a, let me give y'all a y'all first question of the day, so that way I can see whether or not we got some participators in the building tonight. Let me ask y'all first question of the day. Okay. Um, if you had to make a choice, this is a pretty obvious question, but I still want y'all to answer the question. If you had to make a choice, right? Would you invest in the profitable business or the unprofitable business? Which one would you invest in? Y'all talk to me. Okay. So we would invest in the profitable company, right? So here's how this works. I'm going to show you your odds. I'm going to show you the odds of investing in an unprofitable company. Let's do the math. Let's do the math on that real quick. What are the odds of you investing in an unprofitable company if you didn't do any research at all? Let's say you just thought, hey, you know what? I might pop up on the right company. Let's see. I go to here and I say I want a profitable company. That's all I do. I want a profitable company. Boom. Wow. Let's do this math now. Let's do this math. Okay? Let's do this math right now. Okay? So what we can see here is there are 2,856. I'm gonna do the math right here in front of y'all, right? Matter of fact, I'm gonna use AI right here, right? If I have, let's just use the normal AI, right? Let's go back over here. If I have 5,575 companies to choose from, and let's just do the math here. 2,856 of them are profitable. What are the odds of me picking an unprofitable company? All right. Let's check out the odds here. All right. You have a 48.7% chance. All right. You have your odds are 48.7%, almost 50-50, that you will pick a company that doesn't make any money at all. Okay? Now, I'm not saying the odds that you're going to invest in one. I'm saying what are the odds that you'll pick one? Like, so I want to do my research and I want to be the most efficient that I can be, right? So if I want to be efficient, I don't even want to look at an unprofitable company right now if that's my goal. Now, some people want to invest in unprofitable companies. Before you judge that, they are the people who want to get the biggest returns over the long run, right? So they take the biggest risks. Okay? But you've already seen it. We can make some pretty big returns on some profitable companies. So the market from time to time leans towards unprofitable names, but like it's always going to work its way back to the quality. That's what's going to happen, one way or another. Okay? So there's a 48.8% chance, a 50% chance just about, that you're going to invest in an unprofitable company, or I'm sorry, pick an unprofitable company to research. If you don't, um, if you don't actually, screen away some of this weakness. Now, what about free cash flow? Right? What about free cash flow, right? So what if I wanted to make sure that I was dealing with a company whose cash flows weren't so expensive, right? So I just put under 100. I put under 100. All right, that's crazy. Now, watch what I'm gonna do. I'm gonna show y'all something. I'm gonna show y'all a trick. Y'all want to learn a trick? Show y'all a trick real quick, right? You come over here and you look at the price to free cash flow. What's the highest you see here? The highest you see here is 19. The highest you see here is 19. We don't want to invest in anything that's that's more than 2 times this amount. So what I'm going to do, I'm going to say I want anything less than 40. Okay? I'm going to say I want anything less than 40. Boom. Now we have 1,905 companies. Okay? 1,905 companies. So how many companies are left? Let's just do the math here. 1,905 divided by 5,575. All right, what do we got here? All right, 34%. So 65% of companies are already gone. Okay, I repeat, 65% of companies, sayonara. Stay out of here. Okay, now let's keep going. Let's keep going. Let's keep going. Let's keep going. Watch what I'm gonna do here. Watch what I'm gonna do here. I'm trying to show y'all some tricks now. I'm show y'all tricks tonight. All right, check me out. See, it says price to book. All right here is an 8.2. That's the highest, right? So I'm gonna say I don't want anything over 16 if I can get to 16. So the price to book. It says under 10. I'm not gonna do under 10. We're gonna leave that as is, right? We'll leave that as is. All right. Now we're gonna go earnings per share growth this year. Earnings per share growth this year, right? I want that to be positive. Let's see now. All right, earnings per share growth positive. That's now we down to 1,113 companies. So check me out. Here's all I ask. I only asked for three things so far. I only asked for three things so far, and we have 1,313 companies left. All right. We're down to 23% of companies. 23, guys. Okay? So all I asked for was that the company was profitable, that their earnings actually grew in the past year, and that their price to free cash flow is not more than twice the highest benchmark value. That's all I asked for, those three little things. And here we are, 23% of companies are left. So that means over 75% of companies aren't even that good. They're not even this good. See the point of step one? Do y'all get the point of step one? All right, here we go. Sales growth past 5 years. 1 second, guys. All right, so sales growth past 5 years. Same thing. I just want it to be positive. That's all I want. Positive. 1,208 companies. Earnings growth past 5 years. I just want it to be positive. We're down to 739 companies, guys. So let me just make sure we're clear about this, okay? Let's make sure we're clear about this. 739 companies are left. Let's divide that by 5575. That means that 87% of companies do not meet the simple criteria we just asked for. 87%. Now let's go back over here. Let's go back over here. Right? What do we ask for? All right. Let me go ahead and add a little text box here. Okay. All right. These are the criteria. These are the things that we asked for. We asked for profitable companies. Right? That's what we asked for, profitable companies. We asked for low, or sorry, we asked for reasonable price to free cash flow. We asked for positive earnings growth. Right? We asked for positive earnings growth. We asked for long-term, so positive. We asked for positive earnings growth this year. Or let's say TTM, that's trailing 12 months. We asked for positive EPS and sales growth past 5 years. Okay? That's what we asked. That's all we asked for. This was the criteria, okay? We asked for these 5 things right here. Something else. And 87% of companies disappear. I want you guys to understand that that is a big part of the reason why we succeed at finding quality companies on a regular basis. Because we're looking at the rare companies right now. These are the rare breeds. These are the rare ones that we're looking at right now. Okay? So that's step one. Step one is screen the market to eliminate weakness. Okay? Screen the market to eliminate weakness. That's step one. Step two. Sort the candidates by market criteria. Step 2 is to sort the candidates by market criteria. Here's what we're talking about. All right. So you have up here, right here, where your ticker symbols, have up here where your ticker symbols are used right now for your order. All right, so order by, so select the criteria by which the output information will be sorted. All right, select the criteria for which the output information will be sorted right here. So, because we're dealing with multiple industries, right? We can sort that out by many things. But I want to do one thing first. Actually, I want to go over here and I want to hit country, USA. So we're only looking for stocks in the United States. Okay, so we have 30 pages right now. By the way, 30 pages we have. Okay. Now let's go ahead and sort these out. So typically, when I have every sector, we have to sort it out by a valuation metric. So it has to be price to earnings, price to free cash flow, those types of things. Now, because we used price to free cash flow in our model, right? We already know that we kind of have that capped. So what I'm going to do is I'm going to use price to earnings right here. I use price to earnings. So I click here and I click on price to earnings right here. Okay. Now, right now they're in ascending order, which means the lowest price to earnings is first. Now, because I have 30 pages, and I like to bring it down to a number that I can split into 3 or 4, okay? Sometimes 5, it depends, right? But no more than 5 pages. I don't want to split it anywhere more than 5, right? So either 3, 4, or 5. That's how I'm going to split it up every time. Okay? I'm sorry, I can split it into 6 as well. So, or 6. All right? So I have 30 pages. So actually I am going to split it. I'm going to split it into 6. I will split it into 6. So let me show you guys what I got over here. Okay, give me 1 second. Let me show you guys what I got. I'm actually gonna draw this out for you guys. I'm actually drawing this right now. I'm drawing this right now. Okay. Okay. So I'm actually drawing this out for y'all right now. So we haven't sorted out lowest PE to highest PE. All right. 6 pages. Okay. How do we look at it? Okay. We say that page 1 is going to be cheap for a reason. Okay. We're going to say that page 6 is too expensive. All right. We're going to say pages 2 and 3 are the value basket. Okay. We're going to say pages 4 and 5 are the growth basket. Okay. Now what I'm gonna do, so I'm actually gonna take a photo of this, and I'm actually going to send it, um, and I'm gonna turn it into a graphic for you guys that you'll be able to like actually like snapshot and download. All right. I love this new thing that that I'm able to do here. All right. So let me do this right now. Watch this. I was thinking to myself, I could, I'm gonna send it over there so y'all can see it. Hold on. I'm gonna send it over there. Hold on. Y'all, yeah, let me see. Let me show y'all what I did here. Hold on. Oh goodness, this is hilarious. All right, here we go. So I drew it out. I drew it out, right? So here we go. So see, I just pasted it right here. I just pasted it right here. So I'm gonna say, turn this into a graphic that I can use in a slide deck presentation. Let me go to my pro here, and we're trying to create an image. Hold on, let's go to images. Nah, let's see what we can get here. Can y'all see that even just a little bit? Y'all, it's kind of hilarious though. If I could show y'all the original version, y'all want to see the original version? All right, here we go. Here's the original. Let me zoom in for y'all. This the original, y'all. Oh goodness, that's the original. Cecily, cut it out. Cut it out. Ooh, y'all. Not bad, huh? Let's copy that image. Let's bring it over here. All right. New slide right there. All right, boom. Okay, so y'all got that? So market segmentation by PE. Right? Y'all like this? What y'all think? Pretty dope. Can y'all work with that? Can y'all work with this? All right. So your potential value traps are right here. Okay, your potential value traps are right here. All right. So that's going to be page 1. So go back over here. You see how it says down here, right? You have 600 names. There's 20 companies on every page. There's 20 companies on every page, right? So the reality is that you have to treat it this way. Okay? So you take the lowest priced earnings, and these are cheap for a reason. You take the top ones here, and these are right too expensive. Okay? The 4 and 5s are your growth and momentum targets, and this is your growth basket, companies with strong earnings potential. Okay? And then you have your core investing universe here, your core value investing universe. These are high quality companies at attractive valuations, right? Quality at a reasonable price. That's what you're going to have over here. Okay? So, with everything going on in the market right now, momentum names have been running the game, right? Would y'all agree with that? Momentum's been running the game? Yay or nay? All right. So we're gonna go with the growth and momentum names, but we're gonna go with page 4 right here. Okay, we're gonna go with page 4 right here. Y'all with me on that? So I have 30 names. So I'm sorry, not page 4, but group 4. I meant to say group 4. Right? So I'm splitting 30 pages into 6, right? So I'm gonna have I'm splitting 30 pages into 6. So that's gonna be 5 pages, right? So pages 1 through 5 are gonna be, all right, pages 1 through 5 are gonna be the um the ones that are too cheap, right? Pages 6 through 10, those are gonna be the ones that are, you know, that are giving us the most value. Pages 11 through 15 are the ones that are giving us value, but they're starting to get into the growth basket. And then 16 through 20, these are the ones we want to look at, okay? So we put this into 6 different groups. So it's the same thing. I just use the 6 groups because I have 60 pages. I use 6 groups. So the first group, which is the first 5 pages, are value traps to us. That's a no. Okay? So we're going to start on page 16, and we're going to start to look down this list. Um, as far as knowing which one is doing better, right? As far as knowing which one is doing better, it's more of a sense that we've been paying attention over that time period. So you would have seen the the names that are driving the market are the ones that have already been driving the market. So the ones that are up today or the next day are the ones that have been up, and the ones that are down are the ones that have been down, right? So we're the momentum, right? The market is just chasing momentum. They're just buying what's already moving. Is what we're getting at here. Okay. So now throughout that particular move, while we're talking about it, um, we had we had technology leading the way for the most part, right? So I might look for whatever technology names I can find here first. What's up, Issachar? What's going on, man? Happy to see you, brother. All right, so I might look at whatever momentum names I can find here first. All right, so what I'm gonna do is I'm gonna look for the tech names first. I'm gonna start with those. So I'm gonna make a list of the tech names that I find on these pages here, right? So we have, and by the way, another thing that you can do if you wanted to is you can go to groups. So I'm going to right click this, go over to groups real quick. All right, go over to groups and look at this. Technology was barely down on the day. But I'm going to go to the past month, and I can see over the past month, technology really driving the market. Right, past 1 month, past 3 months. Okay, until that changes, I'm going to stick with I'm going to stick with technology names as what I'm looking for right now. Okay. Well, that's what I'm going to look for first. So technology. All right. I'm looking for. Let's take a look at all the tech names here real quick. But I'm looking specifically for tech names. I'm looking specifically for tech names who are. One second, guys. All right. So I'm gonna specifically stick with these pages here. I don't wanna go select the tech sector specifically, right? I don't want to select the tech sector specifically. All right. So the tech names we're going to look at here. We're just going to go through tech names one by one. So NetApp, NTAP. All right. And by the way, so we got step two, which was to sort the candidates by market criteria. Step three is to choose the top candidates. That's step three. My apologies. Step three is choose the top candidates. Okay, that's the next step for us. All right. So let's come back over here real quick. All right. So sorry about that, guys. So we have CNXN. We have ALRM. Let's keep going. We have 5 pages in total, right? 5 pages. We want the tech companies on these 5 pages. We have ADP. We have EXL service. So EXLS. We have CACI. I'm just writing them all down. Okay? This is usually how I work. CACI. All right. We have CPAY, CPAY. We have Jack Henry, JKHY. All right, let's keep going. We have IBM, DLO. Let's keep going. I'm just going to keep going. I'm going to write down all my candidates. All right. PayX. All right. Then I have Gen Digital. By the way, that's Gen Digital is formerly known as Norton. Norton is Gen Digital. All right, Norton Antivirus. Then I have ACI World, ACIW. Then I have SSNC. Okay. Then I have Roper Technology. ROP. Let's keep going. We have one more page to go. Okay. Uh, any tech names on here? I don't think any tech names on this page. So I have 15 names on my page right now. So that means I was able to boil the market down from 5,575 names to 15. Let's do that math real quick, guys. 5,000, I'm sorry, so 15 divided by 5,575, right? Um, let's see what we have here. 0.27. So if we go back to the step one, which is screen the market to eliminate weakness, and the goal of step one was to make sure that we did not have to look at the goal of step one was to make sure that we did not have to look at the entire market right? Because that's just not efficient. We were able to boil the market down from 5,575 names to 1/3 of 1%. Okay? Now. Step 4. Analyze the fundamentals. Analyze the fundamentals. So now, I happen to have a tool that analyzes fundamentals for me. If you don't have a copy of this tool and you want a copy, you can grab it if you want. All right. Give me 1 second here. All right. I'll put in the chat for y'all. All right. I put the link in the chat. You guys can click on that. You'll see it says stock analysis tool. Right. If you click on the link in the chat, you'll see it says stock analysis tool. And that's what I'm going to be using here today. All right. So I want to make sure that we're being, efficient with our time here. All right. I'm going to pin it to the top of the chat. I'm going to pin it. All right. There you go. It's at the top of the chat now. All right. We have to analyze the fundamentals, and this is going to show you everything that you're looking for. So even if you don't have this tool, if you pay attention to everything that I talk about, you'll still know what to look for. Okay. We looked at NetApp today, so we're going to look at CNXN. No, actually, I don't think we did look at NetApp. So I'm going to let this load up. All right. I'm going to let it load up, and then we'll go from there. I probably should have refreshed the page first, but we'll give it a second. So it usually takes about 60 seconds to analyze a stock. This particular tool takes about 60 to 65 seconds to analyze a stock on average. We usually say it's like having Warren Buffett in your back pocket. Let me see if this thing works. Let me see. Like I said, I probably should have refreshed it, but because I already had a company in there. Oh, okay, there we go. So these are all of our names right here. So we don't have any growth forecast or anything like that, but that's perfectly fine. This is what we're looking for right here. You see it says buy with a negative outlook. You see this? It says buy with a negative outlook right there. Okay? So the F score is a 0. I mean, it gets a 0 because their F score is a 5. Right? Their price to book ratio is low enough, but the return on invested capital, they don't get enough of a return on their investment. Right? Price to free cash flow, we already knew that was good because we asked them to give us a good price to free cash flow. Right? Earnings growth is 4.4%. As long as it's positive, we give them a point. Now, the sales growth has not been too good for this company. The price to earnings growth ratio has not been too good either. It's pretty good. The earnings and quality is good. The debt to free cash flow is good. So it's not a very. They don't have a lot of debt. This company, okay, but they have not performed too well along with the market. All right. So what we're missing here is the earnings per share and the forecast. So this probably isn't one of those companies that had a lot of people looking at it. Okay, but they have a negative outlook anyway. So we're gonna skip this company. This isn't one of the companies that that we want. Okay. So again, we just analyze the fundamentals. Analyze the fundamentals, and then you go from there. All right, let's go. What do we got here? We're gonna do NetApp. We're gonna do NetApp, NTAP. So we're looking for companies that have at least a positive outlook. At least a positive outlook. Okay, that's what we're looking for. So again, it takes about 60 seconds to analyze the company. Let's give it some time, and then we'll go from there. All right, so here we go, NetApp, and you can see we do have valuations for the company here. That's because we got the earnings per share and all that stuff. We have growth forecasts for them. So it depends on the company. Sometimes the company just doesn't have that information available. All right. We have a buy with a neutral outlook on NetApp. So this is not as bad as the other company here. Let's take a look at what we have. So we have a F score of a 5. That's a no. We don't like that. The price to book is too high, way too high. But everything else seems to be in pretty decent order. We have return on invested capital of 160%. So NetApp gets a really good return on their investment. So when we talk about return on invested capital, we're talking about, they call it ROIC. We're talking about a company that um, when they take the money that they make and they reinvest it, they make about 161% return on that. That is tremendous returns, okay? Price to free cash flow, solid. Earnings per share, solid. But here we go again. The sales growth has not really been there. Okay? The sales growth hasn't really been there. We have the price to earnings growth. That's pretty decent. We have the quality of earnings. That's excellent. Above 1 means that these guys are making more cash than they're actually reporting. And that's always a plus side. Then we have the debt to free cash flow, which says that they can pay their debts off, all of their debts off, within less than 2 years. Okay, that's what this says. But their relative strength says that they've been underperforming the market over the past few months, right? 6 months to be exact. So, not a really big fan of this one at the moment. Okay, not a big fan of this one at the moment. So, we're going to scratch NetApp off of our list. See what we're doing here? So, no company is going to be looked at any deeper than this unless they can give us a buy with at least a positive outlook. Okay, let's do ALRM. Let's do ALRM real quick. Again, it takes about 60 seconds. We're going to give them 60 seconds and we're going to rock with it. Does anybody have any questions? Put your questions in the chat. All right. Does anybody have any questions about what we talked about so far? Talk to me. So right now, Right now we're on step 4, which is analyze the fundamentals, right? If we find a company that we like fundamentally, step 5 is learn as much as you can about that company. Learn as much as you can about the quality names. Okay? All right, Alarm Holdings. Another buy with a neutral outlook, right? Again, I want positive outlooks. I'm still looking at the what they have here, right? So far, NetApp has been the best candidate, just for the record, guys. So we're clear about this. So far, NetApp has been the best candidate with that return on invested capital that was through the roof. So everybody that comes after NetApp is going to be compared to NetApp. So let me be clear about this. Your F score looks good. Your price to book ratio looks good, right? However, return on invested capital is nothing compared to NetApp. And your price to earnings growth is not good. And your performance is not as good either. Right? So Alarm Holdings, we're not even going to bother, right? See what I'm doing here? So now once you analyze one or two companies, you can start to go through them a lot faster by just seeing who's doing who's really got what you're looking for. Okay? Now I hope y'all really here with me. I hope y'all really paying attention here because when the time comes, I don't go making these decisions by myself. What I like to do is after we learn as much as we can about a company, I'm gonna ask you what you think. I want to know what you think about the company. All right, so let's talk about it a little bit here. ADP is next. So far we don't have any companies we want to learn more about just yet. But if I had to choose one, it would be NetApp. I hope y'all with me on that. Y'all with me on that? If I had to, it'd be NetApp because of that giant return on invested capital. I'm telling you why. If I had to, it'd be NetApp because of that large return on invested capital. So if I got money to go right now, I have to go based on the last 3 companies I looked at. It's going to be NetApp. Now, we finally got a buy with a favorable outlook. Here we go. Let's talk about it. We have ADP. Now these are the guys that publish the employment data. Let's see what we got going on here. F score solid. Price to book ratio solid. Return on invested capital excellent. Price to free cash flow excellent. Now, let me point something out to you guys. These first 4 right here are the most important of this entire analysis. So whenever a company can give me a clean sweep of these four right here, if a company can give me a clean sweep of those 4, then that is the best case scenario for me as far as starting off an analysis. When I have the F score above, the F score is 6 or better. The price to book ratio is giving me a 1, meaning it's below the industry. So let's go down here. So tech has it's less than 2 times the industry is what I meant to say, right? So tech has a price to book of an 8. I want it to be less than a 16 then. That's what we have. Return on invested capital is solid. And my price to free cash flow is a 16. Right? We have here, it's a 19. I want it to be less than a 38 pretty much. We have 16. That's excellent. So when I have all 4 of these at a clean sweep, That is a beautiful thing. Beautiful. So next we have earnings per share growth is good, is positive. Sales growth is not as bad as some of these other ones have been. We could use better price to earnings growth, so we could be, we could do better in that department. Okay. Um, we have the quality of earnings, which is a 1.24. Right. Again, anything above 1 says they're bringing in more cash than they're actually reporting in earnings. Okay. Their debt to free cash flow suggests that they barely have any debt at all. Right. Growth forecast is 6.83%. Return on invested capital is, pretty solid, so we're good with that. The cost of equity is 8.03. So the return on invested capital covers that really well also. Okay. Now, because we like what we just saw, we're going to run an analysis. 1, 2, 3, 4. Okay, it's going to let me know everything that I'm looking for. Let's let them cook. I got my quant thesis, I got my earnings tone, I got my macro stress test, and I have my red flags. Let's talk about it. So let's first look. So again, let me break this down. Because I like what I saw, now I'm going to analyze further. Now I want to know more about the company. I don't want to know more about the company unless they pass the test. Period. And 99.9% of the time, I want the company to pass the test while also having a positive return on invested capital for me. I need this return on invested capital to be solid. I just need a 1 right here. I need a 1 right here. When I have a 1 right here, that means it's good. Okay, if it's a 0, that means it's not good for me. Okay? So the return on invested capital is going to be the most important. The Trotsky F score is going to be the second most important. Price to book, price to free cash flow comes behind that. Okay? One of these days I'll break these down for you, but it's also broken down in the book. Okay? All right. So, the company, they're a global leader in human capital management, providing cloud-based solutions that streamline payroll, talent management, and regulatory compliance for a diverse client base. So the company operates through a high retention recurring revenue model that leverages the vast scale to manage the employee lifecycle efficiency. Major opportunities exist in the continued expansion of its high margin professional employer organization services and the capture of interest income on client funds. Although the firm faces threats from agile cloud native competitors and broad labor market volatility. The stock price could increase if they accelerate their international market penetration, or it benefits from a high interest rate environment boosting its float income. Now, conversely, a significant decline in global employment levels or a valuation contraction driven by its high price earnings growth price earnings growth could lead to a price decrease. And ultimately, ADP remains a dominant defensive incumbent that combines operational stability with consistent cash flow generation in the professional services sector. Right? Now, ADP is currently trading at a modest 2.4% discount to our model's fair value. Okay, now keep in mind that the fair value is already discounted. So this is already a discount. The average analyst target is $265.93. Okay, they're trading at 214. That's a decent amount of upside there, right? That's over 20% if I'm not mistaken. Okay, so I have 20% of upside to look forward to potentially there. All right. Let's take a look at this earnings insight here. So, the confident strategic tone with CEO Maria Black describing the current period as a defining moment for the human capital management industry. Management underscored future growth by raising full year guidance to 6 to 7% earnings growth to 10 to 11%, driven largely by their AI led transformation and the ADP Lyric platform, which is securing significant upmarket enterprise deals. The capital allocation strategy remains aggressive and shareholder friendly, highlighted by a $6 billion share repurchase authorization and a 10% dividend increase, alongside disciplined investments in AI and global product scaling. However, the company is navigating immediate headwinds, including a 120 basis point margin compression in the PEO segment, right? That is the professional employment organization. We looked at that earlier, due to rising state unemployment insurance costs. Okay, now, you see this here, it says ADP Lyric. All right, so watch this. Watch this. I'm gonna keep my AI open over here, right? Watch this. So tell me, all right, hold on. Tell me about ADP Lyric. Okay, we're gonna let that cook over there real quick. Let's keep going. See what I'm doing right now? See what I'm doing? I'm being efficient right now. Let's be efficient here. All right. So now, as a quantitative risk manager, I've evaluated um, ADP using its current risk profile and capital efficiency metrics. ADP functions as a high quality defensive asset within the technology sector, characterized by exceptional capital productivity and robust balance sheet. So ADP is uniquely resilient to rising rates because of its low debt to free cash flow ratio, minimizes interest expense volatility, while its business model benefits from higher yields on the billions of client funds it holds for payroll taxes. Right now, the stock's beta of 0.84 indicates it will likely experience less valuation compression than higher growth tech peers as discount rates rise. Right? During a tech-led downturn, ADP, their massive 55% return on invested capital provides a significant operational buffer to maintain profitability. All right. So you can see here that this is a quality name. So I'm gonna mark them down. ADP, right? ADP Lyric. Let's talk about this. It is a cloud-based human capital management platform developed by ADP, designed primarily for mid-sized and large organizations. It serves as a single unified system that integrates several key HR functions, aiming to provide a more collaborative, personalized, and effective experience for both employees and HR professionals. Okay. All right. So Lyric consolidates essential HCM functions into one integrated system. So core HR, payroll, talent management, time and attendance, benefits administration. Okay. So you see what they're talking about here. So this is an all-in-one platform for businesses to manage um, all human capital. So I'm loving it. Now, I've passed on investing in ADP multiple times throughout my time as an investor, right? Many times as an investor, I passed up on investing in ADP. All right. Now, um, the question is, right, now that I know a little bit more, right, am I interested? You can see here, all right, they don't do too bad for themselves, but it's not the best performance considering what's happened over this recent time period right here. All right, but that could be just providing an opportunity for us. Let's go to stockanalysis.com. Let's type in ADP. What's their 5-year return? All right, so 9.6% over the past 5 years. Dividend is 3.18%, however, so this could improve my dividend profile, which is only about 1.7% right now. So I kind of like these guys for that matter. And the fact that their stock is down as much as it is, right? If you look at what happened before this drop in the stock right here, if you look at what happened here, it was a nice solid uptrend, right? So it's not like they were doing nothing and then just fell off a cliff. They were actually rising steadily. And here we have since June of 2025, the stock has, had a decent drop off, right? About 30% over the past 1 year. All right. So ADP is going to be on my list of stocks that I would consider, all right? Quality names. And I just learned as much as I could about them in that short period of time. Look at how quickly and efficient that was, right? And I learned enough about them this time around that I could potentially see myself investing in this company, especially now that we're looking at it from these prices. Right? What's step number 6? Right? Verify the margin of safety. So let's be clear. Just because I like the company does not mean that I'm always going to invest in them. Right? So let's check a few things here. Number one, right? Number one, I have a 1.4x price to no growth multiple here. Watch this. Show y'all something real quick. Okay, that's where this whole thing comes in here that I showed you guys the other day. Okay, that's where this comes in. A second here. Okay, the no growth value reality check. Let's see here. All right, here we go. See this right here? So they say we're at 1.4 right now, right? So that puts us at about 7%. Puts us at about 7%. So if you have anything, right, that's above this 3.5% right here, 3 to 5%, which I've already confirmed we do, all right, then you're good to go. Okay. Now I would much rather start around 1.3, which says that the company's starting to, you're starting to overpay for this particular point, but it's right at the tippy top, right? Talking about overpay in terms of a discount. Let's be clear about that. What do we have here? Projected growth is 6.83%, which is about 7% there, right? So this 1.4 could work out perfectly for us. It's just about the perfect price. That's why it's so close to, right, this particular price right here. So you see 212.27, that would be the exact perfect price if we base it on fundamental value alone, but we have street value here as well. All right, so when fundamental value is below street value, we take the fair value. Okay? Remember that. When fundamental value is below street value, we take the fair value. When fundamental value is above it, we take the street value. Okay? So, I like ADP at this price. I've verified my margin of safety is there. And we're good to go here. So we're going to run through one more company. Let's see if we can find one more company. We're going to do this again. Okay. So the steps here after you know what you want to look for, right? Analyze the fundamentals. Analyze the fundamentals. If you like the company, learn as much as you can about them. If the fundamentals are good, learn as much as you can about the company. Right? If you like what you learned about the company, then look for a margin of safety. Everybody with me on that? Let's do this one more time before we close out. Here we go. All right, let's do this one more time before we close out. The next company on our list was EXLS. All right, here we go. Takes about 60 seconds to do this. Again, if you want one of these, click that link at the top of the chat. Right, click that link at the top of the chat. And you're good to go. You see it says stock analysis tool. Imagine being able to analyze a company in 60 seconds. Can you beat that? I'm sorry, imagine being able to accurately analyze a company in 60 seconds. There's a difference. Okay, here we go. Excelis. So again, Excelis doesn't have any growth forecast, right? You see no growth forecast, right? So no fundamental value. We go straight off of street value. Okay. So Excelis, we see here that they're a buy with a strong buy with a favorable outlook. So they're trying to come in and take over. Excelis is trying to come in and take over. Okay. Strong buy with a favorable outlook. All right. So F score 6. Price to book solid. Return on invested capital solid. Price to free cash flow is good as well. They hit on every single point, guys. They hit on every single point. All right. They did not miss one point. The only thing they could do better at this point is have a better performance against the market. That's all they can do better at this point. Is that the stock can perform a little bit better. So this is good stuff. This is good stuff. Here we go. Let's analyze them now. So the analysis says the company's a strong buy, exceptional outlook, and we looked across everything, and we can see that the company looks good. All right. Let's see what they do. So we want to look at what they do, right? So they're a global leader in data analytics and digital operations, providing data-driven solutions to optimize business processes in highly regulated industries like insurance and healthcare. Ah, okay. The firm operates through a combination of proprietary technology and human expertise to drive efficiency and digital transformation for its enterprise clients. Major opportunities lie in the rapid integration of generative AI to enhance service delivery, while threats include rising labor costs and disruptive automation that could render legacy business process outsourcing models obsolete. Interesting. So the stock price could increase if the company demonstrates successful monetization of higher margin AI-led consulting, whereas a decrease could be triggered by a slowdown in enterprise IT spending or increased competition from larger global consultants. Now, this like the way I see this, right, is so all this talk about companies may lose business to the people who do AI and so on and so forth, right? If I am a company, I want to get my AI product from the company that knows the industry, not from the company that just decided to throw something together because it's an opportunity right now. All right. So that's why I'm still rooting for these companies to get it right, because we like expertise when it comes down to professional fields. Right? Expertise matters. Um, let's talk earnings insights here. So in 2026, the Q1 2026 earnings call held on April 29th, 2026, EXL management exhibited a confident and highly optimistic tone characterized by phrases like strong momentum and excellent visibility. As they raised full year guidance, future growth is being aggressively driven by their data and AI led strategy, which now accounts for 60% of total revenue. Look at that. What did I just say, right? And grew 28% year over year. The company subsequently increased its 2026 revenue outlook. Um, Regarding capital allocation, they remain committed to shareholder returns and innovation repurchasing 4.4 million shares for $136 million in Q1, while planning $50 million in annual capex focused heavily on AI R&D. Now, this is despite the bullish outlook. Management identified immediate headwinds, including macroeconomic and geopolitical uncertainties, a $2 million foreign exchange drag, and specific softness in the retail and communications sectors, which they are navigating by migrating legacy digital operations into higher value AI workflows. Okay. The stress test here says the company's low debt um, indicates minimal reliance on external financing, shielding the bottom line from rising interest rate expenses. A beta of 0.87 says they have lower systematic risk than the broader technology sector, so on and so forth, right? So when it comes down to forensic audit, earnings quality is, let's see here, price free cash flow is lower than the PE. This is a strong indication of high earnings quality. Right, it suggests that the company is generating more cash than accounting profits. Right, that's what I've been telling you guys all night. Right. Alton says they also have a partnership with um, Google, Nvidia, etc. Okay, y'all heard that. I appreciate that, Aldrin. All right, you heard it here first. So the only notable outlier is the price to book of 6.16. This indicates the market is valuing the company at over 6 times its net asset value. For a services and data analytics firm, this usually points to a balance sheet dominated by intangible assets and goodwill, likely from acquisitions. All right. The primary structural threat is not insolvency, but valuation sensitivity. All right. Conclusion: no severe red flags detected. The company exhibits strong cash flow, low leverage, and high operational efficiency. The high price to book ratio is typical for the industry, but remains the only area requiring monitoring for potential asset impairment. Now, real quick, EXLS. All right, I'm gonna go over here. I'm gonna click on the company's website. I just want to see what they got going on real quick here. All right, Investor Day. Powering the global leaders. They have 150 Fortune 1000 and Global 1000 clients, 16 of top 20 US, UK, and AU insurers. 7 of top U.S. health payers, 11 of 19 U.S., UK, and AU banks. Okay, so they have a great majority of the financial sector, depending on them. Let's see something real quick. You guys are gonna notice something about me. All right, I don't waste my time. I don't waste my time really stewing over, tiny details. Okay, I really don't. My main focus is getting to the decision making portion of this particular strategy here. All right. So when it's all said and done, let's go through this. All right, step by step again. Let's recap one more time. And well, actually first verifying the margin of safety. We already have that. We know that they're trading at $31.34 per share, but we believe the stock is worth more like 37, 38. The average analyst has the stock at $44.17. So that's already at least a 33% upside in the stock. Okay, that's already a 33% upside in the stock right there. Okay, so let's recap. Let's recap here. Step 1, you screen the market to eliminate weakness. What's the criteria we ask for? We ask for the company to be profitable. We ask for a reasonable price to free cash flow, a positive earnings growth trailing 12 months, positive earnings per share and sales growth over the past 5 years. That's what we ask for. All right? Then that should boil the companies down. We ended up with only 1/3 of 1% of the market that we had to look at. In the end, when we were looking at technology companies, only 13% of the entire market was available for us to look at in that regard either. All right. Next, we have, we sort the markets out. We sort the candidates out by a market criteria in this particular case, right? We utilize price to earnings. Okay. We utilize price to earnings. Okay. Price to earnings, lowest to highest. That's what we did there, right? Next, as you can see, once you sort them out, you can then go ahead and split them into groups or if let's say we're left with 6 pages, it will look just like this. These are your 6 pages. Let's say you're left with more like 30 pages like we were left with today. I split them into 6 groups. So 6 groups of 5 pages. So the first 5 pages are cheap for a reason. The last 5 pages are the highest valuations, and they're too expensive for our blood. So we're going to go with these names in between. All right. Step 3 was choose the top candidates. We did so by looking at which sector was leading the market currently, and that was technology. And we picked the names that were ranked, right, in the fourth group here, which is where growth and momentum sits closer to value, right? Step 4, analyze the fundamentals. We research the company, and we want to see whether or not we like the quality of their fundamental factors. So return on invested capital, Petrosky F-score, right? Price to book, all the fundamental and valuation metrics that we look at. Okay. How quality is the company's earnings? Do they have free cash flow? All that good stuff. All right. Step 5, was to learn as much as you can about the quality names. That was step 5. All right. So once you figured out which companies you wanted to look at and look deeper into, you then would you would then actually um, dig deeper into that company and find out as much as you can about them. Then step 6, if you like everything that you find out about the company, then the last step, and let me rephrase that, if you understand the company very well after learning what you could about them, then if you still like them after that, then there's a verification for the margin of safety. Can you get this company at a discount right now? Okay. And if the answer is yes, then you can go ahead and if the answer is yes, then you can go ahead and make your purchase. Right? Um, when it's all said and done, when it's all said and done, this is exactly what we're looking for. 6-step process, guys. 6-step process. All right. And if you're using the tools that I give you for the margin of safety, there's a simple rule that I've been teaching you guys, right? I'm sorry, hold on. We don't need this new slide. I just want to put some all right, simple rule I've been teaching you here. All right. Let's move this over here. For those that are using the tool, pretty simple. If fundamental value is, hold on one second here, let me stress this out. If the fundamental value is above the street value, then we use the street value. And if the fundamental value is below the street value, all right, we use the fair value. Okay? So that is everything you need to know about analyzing a company. If you learn something today and you about to go and handle your business, all right, go and drop one of these pocket rockets in the chat for me real quick, man. All right? Go and drop a rocket in the chat for me real quick, man. Drop an emote in the chat if you about to go and start digging into some names, man. Where we at? All right, drop a rocket in the chat, man. Where y'all at? Who learned something today? All right, drop a rocket in the chat if you learned something today. All right, drop any emoji in the chat if you learned something today. Drop the first emoji in your phone if you learned something today. All right, who learned something? Where y'all at? All right, now this particular slide presentation I will be using on a pretty regular basis. All right. So I want y'all to look forward to that. I'm going to go over this more. I'm going to go over this very often with you guys as much as I can. Whenever we need to go over some basics, I'm gonna revert back to this particular slide. All right. So I hope everybody enjoyed themselves as well. If you haven't yet, make sure you grab a copy of that playbook for stock investing. Link is at the top of the room. I appreciate everybody for swinging through. All right. Yeah, free subs tomorrow. Make sure y'all tap in. Free sub Friday, man. Make sure y'all tap in. Okay. And you never know. You never know who's gonna pick up on something. All right. So it could be you. It could be your lucky day. Anthony called him a sub today. So anyways, y'all. Everybody be blessed. Stay well. And I'll talk to y'all soon. Later.